joining. What are we going to be talking about today? We're going to be talking about three things broadly. The forecast that we've done around IT services and around consulting and systems integration. And I call these the gray forecasts. I'll explain that later. We're going to talk very specifically about a number of companies that are in these forecasts, that are in our coverage of the IT services and consulting space. And then we'll talk about sort of scenarios, the what ifs that we're looking at over the next 5 years. What are the different trends, or what are the different potential things that could happen in the next 5 years that would disrupt that forecast, that would change the way that we look at where the IT services market is going? And that structure broadly fits the way that we put these forecasts together, and Kelly and Lesiczka will go into greater detail on that. But we basically started with, I guess, the middle there. We started with the companies themselves, where we thought they were going over the next 5 years, and then we built up a broader understanding of the larger IT services market. So if we go down to, I'll do it the next slide, here's who you're going to hear from today. And I just want to let everyone know, when you hear from these analysts from this team, if you have very specific questions on anything they say or any of the companies that they cover, on our website, it's super easy to find their email addresses. You can reach out to them directly. We all welcome that. So with that, let's go around the room for some introductions. We'll do Lesiczka and Kelly, and then Boz, and then Kevin. Lesiczka?
Thank you, Patrick. Hello, everyone. My name is Lesiczka Bakalova. I'm a senior analyst on TBR's professional services team. I lead our IT services benchmark research, and I also lead the IT services market forecast, which we just launched and we'll discuss in this webinar. And I'm also expert on specific vendors such as Atos Group, Capgemini, IBM, Kyndryl, and Tech Mahindra. Kelly?
Hello. Thanks, Lesiczka. Thank you all for joining. I'm Kelly Lesiczka. I'm a senior analyst on our professional services team. I lead our management consulting coverage, and I also spearheaded the development of the CNSI market forecast that we'll be discussing in a bit. I also have some coverage within the consulting space, looking at EY, PwC, BCG, and McKinsey, and then looking in the IT space, IT services space, I cover Fujitsu, HCL Tech, Cognizant, Wipro, T-Systems, Cisco, and a few others there.
And hello, everyone. My name is Bozhidar Hristov, Principal Analyst on the Professional Services team. My area of coverage includes Accenture, Deloitte, KPMG, and Infosys for specific company coverage. I also lead our research for ecosystem intelligence, digital transformation, and global delivery and automation.
Thanks, Boz. Hello, my name is Kevin. I'm a senior analyst on Patrick's professional services team here at TBR. Been with the firm coming up, I believe, on 10 years now. I know. Some of the firms that I follow are the more hardware-centric, the services arms of those companies. So think Dell, HPE, also DXC, NTT Data, and I also do cover one of the India-centric vendors, Tata Consultancy Services. Back to you.
Lesiczka, why don't you take us away?
Thank you, Patrick. So with the first topic, how, why, and to what extent did the IT services market grow from 2026 to 2030 that we covered in our IT services market forecast and in our consulting and systems integration market forecast. So the IT, and I'll start with the IT services market forecast. It's a very new publication that we launched. We examined the period over 2025 through 2030, and we published in mid-April. So this market forecast provides a comprehensive and a forward-looking analysis on the IT services market broadly. The report provides estimate of the size and growth of the overall market, and we split into two segments: consulting and systems integration, and the rest of IT services. And within the rest of IT services, we include areas such as business process services, IT outsourcing, application services, and hardware support and maintenance services. So let's start with the bigger picture. The IT services market is really entering a transition period for multiple vendors. We're seeing near-term growth is being driven by managed services and AI-led modernization, but long-term revenue expansion will depend on providers' ability to industrialize AI delivery and to adopt their operating models. On the graph on this slide, you see TBR's forecast for IT services market growth through 2030. We expect the market to continue expanding steadily, growing from roughly 1.5 trillion in 2025 to more than 2.1 trillion US dollars by 2030. Growth accelerates over time, and the CAGR will increase from about 5.2% in the earlier years through 2025 to nearly 7% CAGR through 2030. So now, over the next 2 years in the near term, TBR expects growth to primarily be supported by cost optimization and efficiency-led spending. Multiple enterprises remain cautious with discretionary budgets, but they're still investing in projects that reduce costs, improve resiliency, or prepare environments for AI adoption. Managed services, this is a really big area in demand. So there's managed services, there's vendor consolidation and consulting as well, continue to perform well because enterprises want fewer strategic partners that can deliver integrated transformation outcomes. We also expect application modernization, cloud migration, and cybersecurity and sovereignty to remain strong spending priorities. Importantly, a large portion of current AI activity is still focused on building foundational work. So building the data environments, establishing governance models, and secure infrastructure, rather than having broad-scale monetization. However, there are several inhibitors in the near term. For example, U.S. federal spending remains constrained. Discretionary spending is still uneven in multiple geographies and industries, and many enterprises are struggling to align AI enthusiasm with measurable ROI. Additionally, macroeconomic softness in some regions and delayed project ramp-ups are slowing the pace of large transformation deals. Now, I want to give you some midterm to long-term horizon drivers. So that's roughly 2-5 years out. The market's dynamics will shift. Growth increasingly will depend on providers' ability to operationalize AI at scale and move clients from pilots into production deployments. This will create opportunities for AI-led and platform-based and software-enabled services models. The vendors that can deliver recurring IP-led and asset-based services will be better positioned to expand margins and differentiate. We also expect sovereign cloud, secure AI, and compliance-focused offerings to become more important as governments and regulated industries tighten their requirements around data residency and AI governance. And the area around sovereignty is specifically applicable in the European region. Industry-specific solutions will also matter more. Clients are moving beyond generic AI discussions and increasingly want tailored solutions that are aligned to vertical business processes and operational outcomes. But at the same time, there are long-term risks that come up. AI has the potential to cannibalize portions of traditional labor-based services revenue, especially in areas that can be automated. The core IT services may become increasingly commoditized as AI capabilities diffuse across the ecosystem. Providers will also face ongoing talent and reskilling challenges, especially in AI, data, and consulting. And finally, as ecosystem partnerships deepen, vendors risk losing differentiation if they become overly dependent on hyperscaler platforms. So overall, the market outlook is positive, but success will increasingly depend on how effectively the IT services vendors evolve from labor-centric models toward AI-enabled and platform-oriented and outcome-driven services strategies. With this, I turn it over to Kelly.
Thanks, Lesiczka. So looking at the slide here, we wanted to discuss more about the CNSI market forecast here. And so thinking about how we created the forecast and brought it all together, it's very true to TBR legacy or TBR heritage, you could say, and how we looked at the companies that we know really, really well and some of the key vendors in the space to better understand their strategies, investments, deals, service offerings, and just how they were operating in the space. Given all of the changes and how the companies in the market are changing so rapidly, looking at these was really essential to get a good idea of the way that the market is heading and what exactly is happening. So we closely looked at those companies to help us create those main trends and, like I said, the direction of the market, and those key aspects really helped piece together our view of what was happening, where there are opportunities, where there are problems, like how the companies will be separated into the leaders, laggards, and who will just kind of putt along. So looking at just a general overview of the market, similarly to the IT services space, it's undergoing immense change and it's happening very quickly. Despite the changes, the market outlook is still very positive and it is projected to grow. You can see on the chart here, it's projected to grow at a CAGR of 5.8% over 5 years, out until 2030. The consultancies are trying to figure out how to reshape their businesses and talent pyramids to address the change in demand, as well as to adapt to the impact that AI is having on the traditional ways of working, what they're internally, as well as what their clients are asking of them. And while all of this is happening, they're also experiencing more pressure from external consulting threats. So those coming out of the IT services vendors, as well as some of the smaller niche consultancies that they're able to operate a little bit more quickly and more cheaply. There's obviously quite a difference between all of these services and compared to traditional consulting versus IT services versus the smaller consultancies. But the main note here is that the notion of value and how to showcase showcase their quality and what they're actually providing is really important for these companies to retain a lot of that client base and really showcase what they're doing and how they're able to charge some of the prices they're currently charging. The advance in the technology portfolios too is also something that should be more showcased in a sense, but not so much that it overshadows some of the consulting heritage that these companies have. Look, I just wanted to discuss a few of the main drivers for the market. So the main growth drivers across the space was the rapid technology adoption and optimization related to business transformation. So there was a lot of push and pull on the consulting space to really help their clients understand how to use new technology, as opposed to just adopting AI for the sake of AI, or just we need to be using AI. So kind of helping through some of that and understanding how to actually use it and where it can make a difference, as well as looking at the optimization side, looking at cost takeout, and then how to actually achieve that and make it more sustainable, not just we're doing this once, but keep it going for the long term. Although client budgets were tightened in 2025 and still a bit limited in 2026, there were a good amount of small projects focused on that technology adoption and those conversations, as well as the associated implementation. Underpinning consulting with technology solutions and tools, it will create new projects, but potentially reducing the value of the contracts, resulting in a slower market. But at the same time, investment in talent will be needed to ensure vendors, including the employees or including the clients, can execute on the projects and then the actual use of the technology on the client side. And then just a few call outs on some of the market changes that we are seeing and what we expect to see going forward. So as we all know, AI is changing the nature of traditional consulting projects. So the the way that these are being restructured, the technology that they're coming in, the types of skills that is being more required from these consultancies. So not just that traditional business skill, but now we also need a bit of the understanding of the technology landscape and the offerings and the trajectory or the direction it's headed in. We're also going to see a shift from the billable and non-billable structure to a greater focus on outcomes-based and fixed price deals. We're already starting to see quite a bit of this happening now with the vendors shifting over into that outcomes-based and the fixed price. Clients are pushing more of an emphasis on the outcomes, and we'll definitely see an increase on how to measure the impact of the projects and what's actually being delivered. Demand for talent with skills in both technology and strategy, it's going to be very vital for the consultants for success in consulting. And then lastly, increased pressure from the traditional IT services companies on some of these more established players. There's going to be a lot more overlap. Even looking at managed services, there's a lot more where it'll be more difficult to differentiate in a sense between the groups. With that, I will pass it back as we jump into some vendor examples.
Excellent, thank you. I just want to call out two things that I heard Alitza and Kelly say here that I think are really just so critically important. So Alitza mentioned within the IT services space that IT services companies that could lose their differentiation if they become too dependent on the hyperscalers platforms. I think it's a great point, and it shows that there's an opening for a more creative approach to ecosystems, a more creative approach to alliances. And I think that's one area where we'll see companies that do that will begin to separate with respect to growth from the rest of the pack. And then Kelly mentioned, she mentioned pricing, commercial models, outcomes-based, the difficulty in measuring outcomes-based pricing and outcomes-based engagements. I think that really will be the most significant battleground for consultancies in the next couple of years, how they reorder, how they restructure their commercial models and what outcomes-based actually means. So with that, let's go back to Alitza to start us off with some specific companies in the IT services space. Alitza?
Thank you, Patrick. So this slide essentially shows you the total market share for IT services for 2025 compared to 2030, and the top 5 vendors that will hold largest share, and they're all listed. We'll talk about some of them, but we're seeing and expecting with our estimations that the other category will essentially increase in terms of revenue share through 2030, because there's the new vendors coming in. There's more pressure on the established IT services providers, and others like smaller players, more innovative and AI native IT services providers, and the hyperscalers, for example, who are also expanding in services space, will be capturing market share from the established providers. And I want to talk about a company that's not in the top 5 category here. It's rather in the top 10, and it's called Capgemini. So Capgemini ranks number 8 in terms of market share. It's in the other category that you see here, but I think it's one of the established and leading vendors in terms of revenue size among the vendors that we cover in the IT services market forecast. We expect the company to increase revenue at approximately 6% CAGR from 2025 through 2030, and this is closely in line with our overall growth expectation for the IT services market for the same period. We said around 7% CAGR. And then the company will also retain its market share at approximately 1.6% in 2030. So over the next years, Capgemini will be driving its growth by expanding into AI-enabled intelligent operations, sovereign cloud and industry-specific transformation, and also inorganic contributions from the acquisition of WNS, which just closed in December 2025, And this is where the intelligent operations comes into play and all the AI-enabled capabilities that were brought through WNS in terms of expanding in areas such as business process services, business process transformation through AI. So really big component here in the AI field for Capgemini going forward through the WNS acquisition. Capgemini will also benefit from momentum in large deals, increased AI activities, and public sector opportunities in Europe, and notably around the defense center, which is going through transformation, and that's where Capgemini will use its established brand name and expertise and relationships with the public sector in Europe to continue to grow revenues and perform in line with the overall IT services market. Boz, I turn it over to you.
Sure, thank you, Lisa. The couple of vendors here that are interesting to contrast and compare are probably Accenture and Deloitte. Out of the top 5, Deloitte is the only vendor that's going to maintain its share of the 3% of the top 5. Everybody else in the top 5 are losing some share. I think they're the biggest factor here for Deloitte, and that's the overall IT services market, is their efforts to expand within what they call operate business. And you see on the next slide, the share for Deloitte's CNSI revenue is declining. So if this overall IT services is staying flat, that kind of tells part of the story as well. But again, Deloitte has been really focused on driving operate business as fast as they can. Also, the US has been the market to grow that business. Europe has been a little bit more challenging, just given by the mandatory audit rotation and the longevity of the outsourcing contracts, but certainly have been a part of that growth story as well. The other part is really the relationship with the technology partners and really trying to be as close as possible, with the technology partners from an investment perspective, from a resource development perspective, and so forth. Obviously, just like everybody else, they're relying on the same set of partners. So big questions like what's different about Deloitte, and we do go into greater detail what's different about Deloitte in our ecosystem intelligence research. The Accenture story here is interesting enough as well, because as we know, they are the largest of the IT services vendors that we track, and they'll maintain that number 1 position from a share perspective. But as everyone is looking into what's next in their growth strategy, we know Accenture recently launched their reinvention services business. There's a lot of moving pieces. We're publishing a rather long story around what it all means. We had a chance to hear that directly from the executive leadership from Accenture just not too long ago. So stay tuned on that publication. But in reality, what it means is Accenture is looking for new growth markets, and they understand that it's a lot about protecting the core, which is important, and trying to understand what's next for them as they're trying to maintain a financial health, as they're trying to look up into establish a beachhead in again growth markets like capital projects and mid markets, and really trying to be a little bit more in the forefront of AI. As we all know, AI's ROI story has been a challenging one for many vendors. Probably just given by the way Accenture's AI revenue trajectory has expanded since late 2022 until recently, until they stopped reporting. They're probably one of those success stories when it comes to AI, and probably fall in that small percentage of companies that actually have registered a positive ROI. So even though the share is shrinking for Accenture, they will continue to disrupt the market, and they will be within that other category that people we're right now estimating they'll be taking some share from them. Wouldn't be surprised they're keeping an close eye on some of those disruptors to be scooped up by Accenture in the long term.
Kevin, how about your thoughts on this?
All right. Thank you, Patrick and Boz. Thanks, everyone, for joining. I just wanted to spend a couple minutes discussing TCS, because many of the challenges and really the opportunities that the company's navigating are really pretty applicable across the broader IT services landscape. Even though TCS remains one of the largest and most operationally disciplined vendors, in the industry that our professional services group covers, we expect its share of the overall market moderate slightly through 2030. And, importantly, we see, like everyone's mentioned, we see similar dynamics affecting, some of the other largest vendors. TCS is really specifically has struggled a bit to find its footing after, that the COVID era IT spending boom. Revenue growth slowed, particularly in North American BFSI. That's waned a little bit recently. But management's been navigating those elongated deal cycles, cautious discretionary spending, how they term it, and at the same time, headcount appears to have largely peaked. TCS had reduced headcount by roughly 25,000 employees last fiscal year. While simultaneously training more than 200, I think it was 220,000 employees in what it terms advanced AI skills, which tells me, this is likely not just cost cutting. It's a bit of a cultural shift within TCS, and how the company intends to deliver services going forward, or at least preparing for it. I think that creates a bit of tension within, TCS. Historically, the company's strength was, labor linearity, more people, more billable hours, more revenue. AI has an opportunity to fundamentally, disrupt that model because, those AI-enabled automation and efficiency that increases productivity, while potentially reducing the number of human hours, a client needs to buy. So the big question to me, becomes, can TCS replace that lower value revenue, with that higher value AI-led transformation revenue quickly enough? I see two things that, could hold them back. First, AI cannibalization of, that traditional delivery work. That could outpace growth in, new AI revenue streams. And second, TCS has historically been relatively conservative, commercially, operationally, with, which could really slow its transition towards becoming a more platform-led, IP-led organization. But there's also, two upside scenarios, I could foresee. One is, TCS's successfully leverages its scale, its partner ecosystem, its new 5-pillar AI strategy. And, what it's been terming, it wants to become the world's largest AI-led technology services company, which is a bit out of the ordinary for a more conservative, historically, more known as a fast follower. And the company's already investing heavily across the stack, platforms like Cognos and Wisdom Next and, AI infrastructure investments like Hypervault. In the second, upside scenario would be, TCS's operational discipline that I mentioned, remains exceptionally strong, despite ongoing wage inflation, fresher hiring, training, macroeconomic pressures. Its utilization, its attrition, its operating margin, have all remained in a really healthy range, which really speaks to that company's resource management capabilities and its flexibility and ability to adapt on the fly. So overall, TCS may ultimately become marginally smaller in terms of, relative market share, but potentially stronger in terms of profitability, revenue per employee, and, strategic relevance to its clients if it successfully transitions from, that labor arbitrage giant to more of an AI-enabled transformation partner. I'm going to go ahead and turn it over to Kelly, and she'll discuss the next slide with the CNSI vendors.
Yeah, thank you, Kevin. Excuse me. So on this slide, similarly to the IT services one, we just wanted to call out the top 5 vendors, as you can see, and then the remaining share of the market. So not just the other benchmarked vendors, but the market, the entire market there. So as the others have mentioned, the top 5 vendors are likely going to start losing total share of the market. As you can see, it's shifting into the other group. While it's not significant, it's still something to keep an eye out for, and to understand what's kind of driving that shift, and what vendors can do to kind of maintain their place. And so the first vendor I wanted to call out was Fujitsu. And so Fujitsu has been very diligent in how they are building out their consulting expertise, as well as framing their modernization platform in the market. They're using Fujitsu Uvans, which is really helping them to strengthen their position as well as their ability to deliver on digital transformation projects and that modernization side as well. This is providing them an opportunity to work with larger enterprises across APAC, so no longer just Japan, they are starting to make a difference outside as well, and offer more competitive pricing, which is using some of the different resources they've launched, such as the Japan Global Gateway, as well as showcase their deep technology background. While Fujitsu might be slower to make massive changes throughout the organization, it's also important to understand the impact. They're able to better understand the impact of these changes on their business. So they're able to see how it's impacting each side, each region, and to be able to make a truly positive, impactful change. Their attention to and prompt reduction of unprofitable businesses, as well as the offloading of unprofitable contracts, provides it with a strong advantage there. One area where they might face some resistance is around their limited marketing and recognition outside of key markets. While they do have a strong portfolio and it is resonating with clients, some of the recognition outside of those Japan and close regions could potentially hold them back. But the main point here is the growth around their consulting and how they're not the only ones doing that. So I think it's something to keep an eye on with them, is how they're growing, where they didn't have much for consulting before, growing it naturally from start to finish, from zero to nothing. It's definitely something to keep an eye out for. The second vendor here that I just want to quickly discuss was EY. Their internal approach to EY, to AI, and more of an encouragement to use AI throughout the organization as opposed to mandating that their employees use it, is actually a strong benefit for them, and it will end up leading to higher quality for them. They're actively working to train the entire organization on using the AI tools and to build those foundational skills, allowing them to be more productive and find a positive, not just using it to tick a box or just use it. This is also going to help them with that outcomes-based approach and across all their projects, as they're using it on a way that's making a difference. Whether it's able to be measured at this point, I'm not sure, but they're able to use it in a way that the difference is visible. Their approach to transformation technology, the actual transformation for clients is more internal and process-driven, not necessarily driven by tech. They're looking to drive more meaningful transformation with technology as an enabler, not a driver. So looking for, it's more of an evolution, I would say, of the traditional way of looking at consulting, where they're still trying to solve a business problem. It's not just focus on the technology side, but using technology to get to their to the goal. In some sense, the scale of EY could potentially hold them back. It might take them a little bit more time to fully transition into some of these new areas and really shift their consulting structure, as well as kind of adapting the member firm strategy. But EY does have all the pieces. It might just take a little bit longer to effectively scale them and get them into the places that they would like to. And I'll hand it over to Boz for another example.
Sure, thank you, Kelly. Real quick here, as I mentioned, Deloitte's share in CNSI is declining, from the top 5, and that's kind of like following up on that comment that I made in the previous slide. The vendor I want to touch base a little bit more here is KPMG. I mean, yes, they do lose a little bit of the share, but not as much as some of its direct competitors. I think, what the story about KPMG is, and what's going to help them to protect some of its position within the top 5 CNSI vendors is really a strong balance. I would say the way I think about it is expanding into new area like legal services and trying to invest into more AI-enabled delivery services, and looking into their deal advisory services as a way to secure that trust. I think governance is a big component for them. The extension by extension of the legal and common legacy GRC services, they always had opportunities. So that gives them that edge into what it all means to the enterprise when it comes to AI. So that's a big element there. As I mentioned, they've been investing other areas for growth, and they're looking into, really developing a relationship with the key alliance partners like SAP and Microsoft and ServiceNow. We have to recognize they came a little bit from, I'll say from behind, but they're building their technology kind of capabilities, from a different starting point, I would say, compared to some of its, from Deloitte or Accenture per se. So they are in a position to, right now we estimate they're going to lose a little share, but I think they also have an opportunity to prove us wrong, essentially, as we look into their growth trajectory and the investments that they have placed in those areas that I just mentioned. So I think governance, partnerships, and AI-enabled services, I think, will be a big drivers for KPMG moving forward.
And just two quick points on PwC, and then I want to make a larger point about what we're seeing here. And then we're going to go into the scenarios, and we're actually going to do a poll with everybody. So get ready to vote for the scenario that I outlined. But quickly on PwC, I think the leadership there has been in place now for a year and a half, 2 years almost, 2 years, I think. So as we all know from looking at these companies all the time, it takes a little while, particularly within a big four firm, particularly within a partnership model, to coalesce around the leadership and really start to make a change in the way that a firm is run and where they're going. I think we're now starting to see signs that PwC is picking up momentum as their leadership has really got everybody heading in the same direction. And then the other thing is a number of the trends that we've talked about already. So outcomes based, talk about AI for growth, not just AI for cost cutting. And then actually the trend around consultancy selling software. PwC has experience across all of those elements, and I think that's going to do well for them over the next 5 years, just their ability to continue to translate their own experience into what they're going to be doing well. And then one larger point about the other category here. I think we're seeing that growing market share among the other in both forecasts. The smaller companies, firms like Grant Thornton, Protiviti, companies like LTI Mindtree, EPAM, Hexaware, all of these companies, I think they're the opportunity there. Again, just like I mentioned earlier, where differentiation around hyperscalers is an opportunity for a new ecosystem strategy. I think what the different small companies are bringing to the table and how they're growing more rapidly than a lot of the companies we've been talking about in detail so far. I think those are great opportunity to learn what they're doing well and understand what's happening in those companies and what they're doing that's changing the market. And it's just a good opportunity for the bigger players to learn. So last thing we're going to talk about are some scenarios. What would change, what would accelerate or decelerate IT services revenue growth? What could go right and what could go wrong? And I just want to say we're taking the position that the forecasts that you've seen are what I call the gray forecast, meaning they're the baseline. They're where we start, where we think it's going to go. That said, we're been around long enough to know that things change sometimes very rapidly, and increasingly it seems like rapidly. So what we're going to do is we're going to go around the room here, and each one of us is going to talk about one particular trend or a particular disruption that will do the most damage or the most positive good across IT services and consulting over the next 5 years. So in order, we'll go Kevin and then Kelly and then Boz and then Lesiczka, and then I'll wrap up. And after that, we're going to do a polling question where you can vote on which one you think is the most compelling case for disruption over the next 5 years. So Kevin, you go first.
Right. Thank you, Patrick. Yeah, I just wanted to briefly discuss how I think power or energy availability, could become both an accelerator and, constraint on AI adoption and by extension, IT services growth. And, just as a disclaimer, I'm approaching this entirely from the IT industry perspective, not as an expert in energy markets, utilities, grid infrastructure, as I am not. But it's becoming increasingly clear that scaling AI requires far more than, just better models and software. And the numbers are becoming, difficult to ignore. Some forecasts suggest global data center electricity demand could more than double by 2030. Driven primarily by those AI workloads, while in the US alone, data centers could approach 10% of the total electricity consumption by the end of the decade, so in the next 4 years. That's a massive, infrastructure shift needing to happen underneath the AI, conversations that we are, always having. From an IT services perspective, this creates both opportunity and disruption. On one hand, AI infrastructure build-outs drive demand for cloud migration, cybersecurity, data modernization, AI orchestration services, but at the same time, delays in power generation, grid connectivity, permitting, are already slowing some of the AI-enabled data center projects. And these facilities are, not simple to build. Hyperscale AI data centers, take years to develop and bring online. And that pressure is now forcing technology companies to think differently. Microsoft, Google, Amazon, the big players out there, have already announced investments tied to energy. Including nuclear, solar, wind, and other alternative energy strategies to secure long-term power access for AI infrastructure. We're even seeing discussions around small modular nuclear reactors as potential long-term solutions. IT services vendors are reacting as well with AI and infrastructure and data center build-outs. TCS, for example, has discussed investments in AI infrastructure through its Hypervault, AI-enabled data centers, as part of the broad, ambition to become that world's largest AI-led technology services company. NTT Data is, similar, shifted towards newer, those AI-enabled data center investments, following a string of, legacy infrastructure and data center divestments previously. And if power truly does become a bottleneck to AI adoption, consultancies and IT services firms, likely will find opportunity on, both sides of the equation. The same firms helping clients deploy AI today could eventually help enterprises, navigate energy readiness, infrastructure planning, regulatory complexity, operational, resiliency across industries. This could be a webinar in itself, with all the implications, but for the sake of time, I'll just stop there and I'll hand it over to my colleague. I think it's Kelly.
Thanks, Kevin. So I just wanted to talk a little bit about ROI and the impact that will have. As we touched on it a little bit earlier as well, but as many projects are increasingly being tied to outcomes, and clients will begin to look more at the impact that the technology, the AI, the transformation, what it is actually doing, and if it's actually making a difference for their organization. There are still a lot of questions about how to effectively measure the return on these investments, in particular AI, but I think it's across the entire technology spectrum. So how to measure the return from that on, from productivity, how to measure the impact on productivity for clients. But as projects are being moved from pilot to scale, there will be a greater push to actually see what value is actually being created, what benefit is actually being provided. In looking at ROI, I think we'll see a clear definition between the leaders and the laggards when looking at the IT services providers, based on the quality of that transformation. We'll be able to see who's leveraging technology, who's just leveraging it, as opposed to making tangible changes across the organization to actually make a difference. So not just from a marketing perspective, but what's actually making a big difference. And with that, I'll pass it on to the next one.
Thank you, Kelly. So I'll talk about people, right? We always say that it's not technology, but people are the problem. I think this time around, the way we think about people as a disruptor moving forward is everyone's been looking at the people side of the equation. What does that mean to the professional services firms looking into the future and how it's going to all work out, right? What's that the pyramid's going to look like? What's the shape? What's the right pricing model? And what's the mix between digital labor, human labor, and whatnot? My take on the whole, implication around AI and looking into the future is that while we may not see the same kind of a people expansion kind of a growth rates that we saw in the last 20 plus years with outsourcing being around for, for the last 2+ decades, the net effect of AI, I think, will be a headcount expansion. What I mean by that is, and I think it's going to be a headcount expansion for the firms that actually know how to monetize all the investments and reinvestments in the technology and develop the right pricing commercial model, as well as the right partner model along the way as well. Because while we may not see 10-15% quarter after quarter headcount expansion, we're sure going to start to see a rebound in headcount into maybe 2 to 3 to 4, 5%, and the majority actually you expect to be into the more of a low level, kind of like freshers out of college. Those are essentially people that, especially class of 2026, they were sophomores when GenAI came around, so they have a 3-year head start. So you're getting a fresh cohort of graduates that are used to working with the technology, and their onboarding time is likely faster and maybe cheaper than maybe the cohorts prior. Maybe it's even trying to retrain someone who was doing one way for 20 plus years. No offense to people who has been doing years for 20 plus years. Just thinking about the dynamics. So while we may be in a period of like what's going to happen with your jobs and how things going to play out, and there's certainly going to be some churn, I think there's opportunity for the companies that know how to balance people and technology, again, through the right commercial and partner models, will be the one to succeed. And we have started developing, actually, here in TBR, what we call AI Disruption Index, supported by an internal proprietary modeling methodology called Human Intensity Reduction Index, where we track essentially how companies are rebalancing their pyramid and what's the impact of AI and utilization and pricing and offshore leverage, and all these kind of like puts and takes into the company's performance, and how are companies actually driving that index up while they're also driving profitable growth up. Right now, we are like in the transition time, if I can summarize it that way. But it's an index that gives us a good sense of like which companies are doing better than others for the time being. With that, I'll turn it over to Lesiczka.
Yes, so my topic is partnerships. And partners will not be a differentiator just by themselves. One of the biggest disruptions around partners is that nearly every IT services providers is partnering with the same hyperscalers and AI vendors. We're seeing vendors across the board partnering with Microsoft, Google Cloud, AWS, OpenAI, Salesforce, SAP, for example. There's just some examples. The ecosystem is becoming highly concentrated. And this creates a major differentiation challenge because access to the technology itself is no longer unique. So the result is that IT services vendors cannot rely on partnerships alone to stand out. The differentiation increasingly becomes a topic of how effectively the IT services firms integrate those partner technologies, how they build the industry-specific IP, deliver measurable ROI, and combine AI with consulting, data, and managed services expertise. The other area is pricing. It's also becoming a major differentiator. As AI and cloud services become more standardized, the clients are putting greater pressure on the vendors to provide value and to deliver outcomes at lower costs. So that is pushing IT services vendors to be more flexible, to have more flexible commercial models, to have automation-led delivery and platform-based services so that they can protect their margins while they remain competitive. So in summary, the partnerships themselves are no longer a differentiator, but areas such as execution, pricing strategies, and business outcomes are. Patrick?
Thanks. So I'm going to just say data sovereignty and balkanization. We all know what that means. 3 quick points on that. It's why I think it's the most disruptive thing that's coming in the next 5 years. For one, it's an acceleration of an existing trend. Secondly, it's going to benefit those smaller, regionally focused IT services and companies and firms, the ones that we saw growing in market share. And then third, it reveals that there's going to be an even greater need to partner well, to Elitsa's point. You're going to need to partner well in order to get scale, even in a balkanized market. And then I guess it's sort of a bonus point here, creativity around commercial models, to Elitsa's point on pricing, and an emphasis on internal governance, being flexible but trusted, auditable AI. I think all those things are going to make data sovereignty sort of the next big thing. So with that, let's go to the poll. So here we have it. What is the most likely disruptor? Is it going to be people, as Boz said? Is it going to be power for AI? Kevin's argument. Elitsa's partners. Kevin's ROI. Kelly's ROI. Elitsa's commercial models. Elitsa, anyway. New entrants. My data sovereignty is just the one you should vote for. And then, of course, macroeconomic. Would that be the thing that disturbs it most of all. So there's the poll out there. And I want to answer real quickly one of the questions we got in the queue, which is I've not seen any AI partnership announcements for EY, unlike most of the big four, Accenture, McKinsey, Bain, and BCG. Sort of three quick thoughts on that. One, they actually, I think today or yesterday, had a big announcement with Microsoft. Was it today? Yeah. So I think when we think about EY and what they're doing with respect to AI, it's that Microsoft partnership that's the most important thing for them. Secondly, I would say it's with EY, it's watch what they do, not what they say. They're good. They've been pretty disciplined about that over the years, particularly when they were going through the whole Everest thing. They were still operating, sort of high speed, low drag, despite what they were doing internally, what they were debating internally. And then I would add the last thing, and this definitely reflects spending a couple of weeks with them over the last couple of weeks. The sort of ethos within EY is that AI is very much a tool. It is not the solution to every business problem. So if you're not seeing as much hype from them, it's up from a lack of activity. It's from a lack of them hyping up the activity that they are doing. And the last thing I'll say before we go to the results of this, do I need to go to results right? That doesn't close the poll, does it, when I hit results? I know. Okay. We'll see what happens when I go to, well, I'll wait for just another minute. Last thing I want to say is just Boz mentioned very briefly the AI disruption index, which we're rolling out this month going into next month. That looking at every single company, as we do at TBR, looking at the companies themselves and saying what is the disruption that's happening because of eternal adoption of AI, what is it doing to their business models? And then he also mentioned the human intensity reduction index, which gets to one of the other questions that was in the queue about what's going to happen to people. So with that, let's go if we can see the poll result. Oh, here's the poll results. Looks like not enough votes for data sovereignty, just 33%, but I'll take it because that's going to be a win for me. So love it. We do have some other questions here that we'll get to really quick. We're just about out of time, but one of them was how is the offshore staff of SI companies going to get impacted by AI-led growth and how can they stay relevant? Boz, anything else you want to add to what you said earlier about people?
Yeah, I think kind of like was just maybe adding a little bit more to that. I think that the big factor here is about training, but training not for the training that those companies we start hearing a lot more companies saying you must do AI because it's going to be part of your evaluation and your performance measurement, yada yada. To me, that often sounds like it's a little bit more of is it for compliance or for quality? That's the question. Yeah. So I think the companies that actually start doing it for quality and actually think about a little bit different about training and less about just check the box to say we have hundreds of thousands of people train on AI, but actually do it in a more pragmatic way, in more of a way that actually drives innovation and trying to be a little bit more creative of like applying it and applied AI. I think will be critical because we hear on the other side partners like Meta talking about the applied AI kind of a new form venture that they're doing internally. And the big differentiator they're betting on is actually pulling AI. I mean, basically software engineers that have a AI experience to be the AI auditors, so to speak, right? Yeah, Meta just announced 8,000 people layoffs, but they also restructured 7,000 people internally. So that's inevitable in the environment we operate right now. But talking about professional services companies having armies of people, especially in the offshore environment, the important part is about understanding, like not just say we're AI enabled. Everybody's AI enabled. You can go on ChatGPT, you can go on Cloud and use that. What it means is in practice, I think that's more important. It's finding the way to message it internally first before going externally. I think it'll be important how the talent, that pyramid transforms and has the potential of positive impact on ROI for the company.
Excellent, thanks. And for the person who asked that question, if you have follow-ups, please feel free to reach out to myself, reach out to Boz, anybody on the team. We can jump on the phone and talk further on that. So the last question we have today that we have time for is, do you see more M&A of niche players as a strategy considering sluggish growth outlook? Yeah, so the answer is yes. And in fact, I'd go so far as to say it's going to be coming sooner probably rather than later. Our growth outlook there was over 5 years. And if we were actually debating before this webinar started, are we going to see that growth go down? And I think if you look at the last 5 years and the next 5 years, it sort of looks like a plateau. It's very slow growth. But if you go back another 10 years, you'll see that there was a lot more growth previous to that. So we have definitely plateaued, and there need to be growth strategies. And one of them is certainly going to be M&A. I think the huge challenge that we see repeatedly with M&A in the IT services space is that the companies that have the like business models are much more capable of absorbing and getting a return on the investment in M&A than the ones that are trying to buy something that's in a different space. So if you're an IT services company and you're tech-centric and you buy a consultancy that's people-centric, that's a cultural challenge as much as it is a running the business, an operational model challenge. So what are we going to see? Are we going to see a big four firm or one of the MBBs make a dramatic move and scoop up one of the smaller consultancies? Very likely. Are we going to see one of potentially one of the hyperscalers or even one of the AI frontier companies scoop up a large IT services company as a way of sort of shoring up their own services component of what they deliver? I think that's also very likely. I think we're also going to see one or two of the companies we've been talking about today, or at least are in our coverage, probably haven't mentioned them today, disappear, just because the market is becoming so insanely competitive that it's going to be hard for some of these companies to stay on when they're already cannibalizing some of their own revenues through AI. So I think we will see a lot of activity, a lot of M&A activity in this space over the next few years, and I think probably some of it as soon as this year. Boz, other thoughts on that?
No, I agree. I think obviously we've seen some of the PE moving into that space as well, so that's a big disruptor. I think as we look at the overall enterprise IT spend, we know that buyers are not developing 20% growth on their IT budget, so they are reshuffling in priorities. So what does that mean is that monies are being spent somewhere. So for IT services companies to ensure that they are staying relevant for growth, they may have to look into new markets for them, because some of the enterprise budgets that are labeled as IT may not be directly going to specifically, the services component, but maybe going to more of the technology infrastructure, data center management and whatnot. So I think this is kind of like you have to kind of expand your horizons in order for companies to go after those acquisitions essentially, and look into more of a specialized firms that will create new markets, will create some growth opportunities, but also some challenges for integration, because different companies with different cultures and different portfolios. Good luck.